The following video is an extract from the Udemy course, Learn to Construct Financial Statements from the Ground Up. If you would like to purchase the full course, you can do so by using the link below. So now we have covered the three primary statements, I am now going to discuss the difference between an accruals basis of accounting and a cash basis of accounting. First, the accruals concept. The accruals concept, or accrual accounting, is the concept that accounting transactions should be recorded in the accounting period when they are deemed to occur, rather than in the period where the cash flow is associated. So there can be a disconnect between when a transaction occurs, in terms of when a service is received or a sale happens. So there could be a difference between that event and when the associated cash flow actually happens. So the accrual accounting accounts for transactions as and when they are deemed to have occurred. By contrast, a cash flow basis of accounting is then accounting for the movement of the money as it physically moves into and out of a business. So we're going to demonstrate through, by way of an example, to illustrate both of those concepts. So in this example, a company has an accounting period end of 31 December. That is, they prepare accounts every year on the period 1st of January to 31st of December. That is their accounting period. So in this example, let's say a company purchases and receives a service on the 15th of December 2020. So that is within the year ending 31 December 2020. In terms of when that service is paid for, in this example, there is 30-day credit terms. So that those 30-day credit terms would take us into 15th of January 2021. So the cash impact doesn't happen until the next accounting period. So let's just illustrate this in terms of this blue line. This illustrates the year ending 31 December 2020. So in terms of when that expense is received, it was received pre-year end, you could say. And then in terms of the cash impact, that happened then in the following accounting period, i.e. post year end. So let's distinguish between an accrual basis of accounting and a cash basis of accounting in this example. Under accruals accounting, an expense would be recognised at the 15th of December 2020. So an expense and a liability would be recognised under an accruals basis of accounting, because at that point it is deemed that a liability has been recognised because they have received that expense. Under a cash basis of accounting, as we said, cash accounting happens when it recognises cash as and when it physically moves in or out of the business. So in this case, the cash impact didn't happen on the 15th of January. So under a cash basis of accounting, that's when that would be recognised. So that's just an illustrative example. Hopefully you found that useful. So just by way of summary then, in terms of the three primary statements we've introduced you to, the income statement, the balance sheet, and the cash flow statement. The income statement and balance sheet are prepared on an accruals basis of accounting, whereas the cash flow statement, as the name suggests, is prepared on a cash flow basis of accounting. And then in terms of the period in which these primary statements report over, the income statement and the cash flow statement report over a period of time. The income statement reports revenues less expenses to give a profit over a period of time. That period could be 1 month, 6 months, or a year, for example. Whereas a cash flow statement reports the cash from the beginning of the accounting period to the end of the accounting period. Again, that's over a period of time. By contrast, the balance sheet reports assets, liabilities, and equity at a point in time. So they're just the key takeaways I want to take from this lesson. In the next tutorial, we will expand on these concepts a little bit further. There will be a quiz question now just to consolidate what you've learned. But do that, and I will see you in the next